Oil is trading at wartime levels while equities sit at record highs, and the usual correlations across assets are starting to creak. This is vTalkInsight, Allocator's lens daily from May 1st, 2026, where we connect those cross-asset threads for decision makers. In equities, the striking feature today is how far prices have run in the face of mounting macro risk. The S&P 500, NASDAQ benchmarks, and the Russell 2000 have all printed record closes, with the S&P up around 10% and the Russell roughly 12% for April, even as oil spikes and bond yields march higher. Equity volatility remains subdued, which tells you the equity market is still leaning into the earnings and AI story rather than the energy and policy shock narrative for now. The earnings backdrop goes a long way toward explaining the resilience. U.S. corporate profits are expected to grow about 8% this year, with nominal GDP near 5%, and S&P 500 earnings growth forecasts have been revised up toward the high teens in percentage terms. Importantly, earnings for the S&P 493, excluding the largest tech names, are still running in double digits, helped by robust results in areas like industrials and autos, as well as companies tied into the AI ecosystem. Recent quarters have delivered repeated double-digit earnings beats versus consensus, reinforcing the sense that corporate balance sheets and profit margins can absorb a fair amount of macro noise. The AI investment cycle is the other key pillar. Major tech platforms have lifted combined capital expenditure commitments toward $750 billion over the next couple of years, with AI-related capex alone pushing up toward 30% of revenues for some businesses, roughly twice past norms. Semiconductor sector earnings are forecast to nearly double year over year, far outpacing the broader tech universe, underscoring how central chips have become to index-level growth. Alphabet offers a good illustration. Cloud revenues jumped more than 60%. Its backlog sits in the hundreds of billions with a large share recognized within 2 years, and search growth nearly 20% has eased fears about AI cannibalizing its core business, all of which the market rewarded with record highs. Under the surface, though, the leadership is anything but uniform. Alphabet and Amazon have been rewarded for AI spending that is already translating into faster cloud growth and clearer monetization, while Meta has come under pressure as investors question whether its planned AI outlays will deliver the same payoff. Within semis and hardware, names tied most directly to data center build-out and custom chips are seeing the strongest upgrades, while others lag. Retail investors have returned aggressively to U.S. equities, especially mega-cap tech, and more than $1 trillion of corporate buyback authorizations adds another steady source of bid, even as hedge funds keep net exposure relatively low. The picture in Europe is more nuanced and more exposed to the energy shock. Energy and defense stocks are providing some support to indices, with energy names and markets like the UK offsetting weakness elsewhere, but cyclical sectors such as autos, chemicals, and discretionary consumption are under heavier pressure. French banks have boosted macro provisions well beyond market expectations, signaling caution on the outlook even though current client performance has not yet deteriorated markedly, while a bank like Standard Chartered, with a focus on Asia and the Gulf and strong wealth inflows, is faring much better. Persistent high energy prices and stagflation risk therefore weigh more heavily on European equity risk premia than on U.S. benchmarks, which still benefit from stronger earnings momentum and greater energy self-sufficiency. The main challenge for equities from here is how long earnings and liquidity can outrun the energy and rates backdrop. Brent has surged into the low 120s per barrel after a roughly 30% move in just over a week, close to levels where past cycles have seen demand destruction, and analysts expect triple-digit oil to start biting into growth and profits after a few months if sustained. Airlines are already warning that higher fuel bills will hit with a lag, and higher gasoline prices threaten to erode consumer spending, which has been a key prop for the U.S. economy. So the equity market narrative now hinges on whether strong AI-driven capex and broad earnings resilience can continue to offset tighter financial conditions. The answer will depend heavily on the path of yields and policy, which brings us to rates. Rates markets are still digesting a powerful shift higher in yields alongside a much murkier policy outlook. Government bond yields across the U.S., Germany, the UK, and Japan are sitting near multi-year highs, reflecting a reset in inflation expectations as well as doubts that central banks can cut anytime soon. In the U.S., the long end has been especially volatile, with the 30-year Treasury yield moving above 5% recently and the 10-year around the mid-4% area after a small flight to safety rally. The inflation data are what keep policymakers and bond investors on edge. U.S. core PCE inflation is running above 3% year over year, and the latest quarterly reading over 4% is the highest since early 2023, while euro area print from countries like France and Spain have surprised to the upside and remain above target. That backdrop has pushed markets to price a material probability of another Federal Reserve hike by early next year and to expect multiple hikes from the European Central Bank and the Bank of England, even as earlier expectations for Fed cuts have largely evaporated. Yet the central bank messaging is more cautious than those pricing swings suggest. The Fed is experiencing its most divided committee in decades, with a rare cluster of dissents, but the median view still points to staying on hold and waiting for clearer signs of labor market softening before contemplating cuts or fresh tightening. The ECB and the Bank of England have both left rates unchanged while flagging downside risks to growth and upside risks to inflation, and officials across Europe stress a wait-and-see stance as they watch how the oil shock feeds through. Behind that is a recognition that aggressive tightening into an energy-driven slowdown could turn a stagflation scare into a hard landing, particularly in the UK, where some see current market pricing for several hikes as a potential policy mistake. For multi-asset portfolios, this means bonds now offer much more income, but less obvious diversification benefit. Investors are favoring the front end of curves, where yields are high and duration risk is lower, while demand for very long-dated paper remains subdued despite the elevated coupons. At the same time, some argue that today's energy spike is a temporary shock, that core inflation trends are moderating, and that the U.S. economy is structurally less sensitive to oil than in past crises. The next few inflation releases, wage data, and central bank minutes will be critical for whether yields stabilize here or another leg of repricing is needed, with direct implications for how far equity valuations and credit spreads can stretch. Credit markets, for now, still look relatively benign on the surface. Public credit is offering around high single-digit yields overall, and investment-grade spreads have compressed to below 1% despite heavy corporate and sovereign issuance, signaling strong demand for high-quality paper. Large tech borrowers are easily tapping markets to fund AI and data center capex, with one recent $25 billion bond sale from a big platform company drawing almost 4 times that in orders even as its equity traded sharply lower. That mix of high all-in yields and easy market access is consistent with the broader risk on tone we still see in equities. Beneath that calm, however, the distribution of risk is widening. Persistent supply from hyperscalers has started to push their bond spreads gently wider, creating more challenging technicals even though demand remains strong, and the sheer scale of data center capex raises questions about how long profitability will lag accounting depreciation. In software and technology more broadly, the cost of debt has risen by roughly 250 basis points versus calmer periods, and private credit portfolios that rely on software as collateral face added uncertainty as AI reshapes business models. European banks are another focal point, with major French institutions increasing provisions and facing rising capital needs for technology and risk buffers, which could squeeze room for generous dividends and buybacks over time. Offsetting those concerns, there are still no signs of a broad-based credit crunch. First lien senior secured loans in private markets are described as resilient. Capital remains available for deals, and the outperformance of high beta equities like small caps suggests the system is not pricing in an imminent default wave. For allocators, the message is that credit continues to underpin the current risk stance, but the cushion from spreads is thin in some sectors, especially leveraged software, energy-sensitive industries, and parts of European banking. Watching how new issuance clears, how spreads react to any earnings disappointments, and whether provisions creep higher from here will be key for spotting an inflection point ahead of the equity market. Commodities, and oil in particular, remain the macro hinge for all of these cross-asset stories. Disruptions in the Middle East and the ongoing conflict affecting Russian exports have removed an estimated 5 to 7 million barrels per day from the global market, at the same time as the Strait of Hormuz faces closures, tolls, and sanction risk for shippers. Reports of potential U.S. military action and a heavier naval presence in the Gulf have pushed Brent into the $120+ range, with a jump of around 17% in just a few days and brief spikes even higher. Markets now talk openly about a sustained risk premium in crude, even if shipping lanes partially normalize, because the geopolitical backdrop remains so uncertain. The tightness is not just about near-term conflict headlines. Strategic petroleum reserves have already been drawn down by more than 400 million barrels globally and could be largely exhausted by the summer if current release rates persist. U.S. shale producers are not responding aggressively despite higher prices, in part because many are hedged at lower levels and are prioritizing gas production and balance sheet repair over rapid oil growth. An extended closure of the Strait of Hormuz could force Gulf producers to cut output simply because they run out of storage, amplifying the projected shortfall of around 1 billion barrels and pushing refined product prices, like diesel and jet fuel, toward extreme levels for import-dependent countries. That commodity backdrop feeds directly into the stagflation worries showing up in rates and equities. Elevated oil and gas prices tighten financial conditions, lift headline inflation, and eventually erode real incomes, which is particularly problematic for Europe and parts of Asia that rely heavily on imported energy and outsourced refining. Aluminium is another example, where structural issues at smelters in the Gulf have constrained supply, pushing prices from about $3,000 to $3,500 per ton and boosting producer earnings now, but threatening to crimp demand in construction and autos later. The U.S., by contrast, benefits from being a net energy exporter with strong domestic food and technology sectors and a lower energy intensity economy than in past oil shocks. But even there, higher gasoline prices risk undercutting consumer spending if they persist. Layered on top of all this is the energy transition, which is reshaping both risk and opportunity in commodities. Regions like Texas have rapidly scaled solar and wind so that they supply more than half of daytime electricity, with battery storage expanding to tens of gigawatts in just a few years. Yet grids still lack enough firm generation to guarantee reliability in extreme weather. Countries that prioritize green policies while outsourcing refining capacity may now face some of the steepest increases in refined product prices, underscoring that the transition pathway matters as much as the end state. For cross-asset allocators, monitoring how oil, gas, and key metals like aluminium trade relative to growth data and policy signals will be crucial for judging whether the current energy shock remains manageable or tips the system toward a more painful stagflation scenario. Stepping back, the cross-asset picture today is defined by a tension between powerful growth and earnings forces and an increasingly aggressive energy and policy shock. Equities are still leaning into the AI and profit story, with record highs and broadening participation, while rates markets wrestle with sticky inflation and divided central banks, and credit remains supportive but with thinner cushions in leveraged and energy-sensitive sectors. Commodities, especially oil, sit at the center of that web, shaping inflation expectations, policy paths, and ultimately how sustainable the current risk-on stance proves to be. Over the coming weeks, the interaction between energy prices, incoming inflation data, and corporate margin guidance will be the key set of signals for multi-asset allocators. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.